Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation. And today I'm going to be covering Amgen, the world's largest or one of the largest biotech stocks in the world. They kind of built their franchise, if you will, on the cancer therapeutics, the Neupogen and Epogen initially, and now they've got numerous stocks in the pipeline. I'll kind of get into that detail later. Well, yesterday the stock fell about 7%. Now, people tend to react to those kinds of stock drops, and I believe they overreact to those kind of stock drops. I'm going to try to put all of that into perspective as I kind of cover this company in the video, but there's also several other reasons that I felt that it would be very interesting to cover Amgen. It provides a lot of lessons on how not only investment philosophies or strategies can change for the individual investor as they go from being, young and aggressive and working hard to getting, middle age and then finally getting older where they might get into retirement years. And, so in other words, your thoughts about investing will evolve. Businesses tend to evolve like that as well. And Amgen, I think, is a great case in point. Another thing I want to cover here, I did have a comment on my last video where someone commented that they really would like to take a look at FastGraphs, but they just really felt that it was too complicated and too hard to use. And of course, I'm very biased and very proud of the tool that I developed. And I often say that I couldn't even imagine investing in stocks without the advantages that FastGraphs brings me. But one of my other sub-objectives, if you will, for this video is to illustrate just how easy it is to use this powerful tool. And I've got hopefully you'll agree, a kind of a creative way to try to illustrate that for all of those of you who've been contemplating the tool. But at the end game, I'm really trying to take a look at Amgen, and I want to also talk about why I am long the stock, and I am long the stock, and what my objective is for investing in it. As I mentioned earlier, investment objectives change. So let's start by taking a look at Amgen. Look at what happened yesterday after it fell. It's recovering a little bit today so far, at least last time I looked, and talk about what the long-term prospects are. But we're going to learn from the past. We're going to evaluate the present and then look to the future as we go through this process. So let's go ahead and get with it. Now, what I've got here is I've got the FastGraphs using the all metric, which we go back 20 years. That's how much data we purchase. That's the only reason we go back 20 years. And what we do is we apply a valuation reference line on the graph. In other words, a line that is theoretically representing what the fair value or intrinsic value or true worth, as we like to call it, value of a business would be. And I call these valuation reference lines. And we use formulas to do that. And I'm not going to get into that detail now, but what we end up with for Amgen is a PE ratio of 15, which represents an earnings yield of 6.5% to 7%, which I talk about quite often. But here's the point. Everywhere you look on this orange line, it's a PE ratio of 15, okay? And that's fair value. Now, what does this line also tell me in addition to just a fact that it represents a 15 PE ratio? It also gives me a picture of how, successful the company's been historically and what its growth rates have looked like. So I want you to take note that this company's had an average growth rate of 13.46%, including the prospects for the next couple of years, which is the light green shaded area, going back to the end of calendar year 2000, just as we entered the first recession of the two that we've had over this time frame. And then, of course, the Great Recession. And now we have the COVID recession, which isn't marked on the current FastGraphs yet. All right, so now I've got this very consistent picture of earnings growth. I get little periods where you can see the line flattens, but generally I've got very strong growth at about 13.5%. Now, FastGraphs does all the heavy lifting for you. So the other thing is I want to determine, I've got several ways to do it with the tool, but I'm going to do it right here on this aspect. I can chop off 5 years here, and I can see that my growth rate now has fallen to 10%. So I've lost, about 3 percentage rates of growth as the company has gotten bigger and bigger. I drop off 3 or 4 more years. I'm only going to go down to 11 here. Now my growth rate still stays double digit, but watch what happens when I go to 8 years, which is giving me about 5 years or so, 5.5 years of history, and then a couple of years, 2.5 years of forecast. My growth rate is now down to 8%, 7.97. Well, all that's telling me is this company is, changing over time. The bigger it gets, the harder it is for it to grow, and the more the growth rate slows. But I've learned a great deal about the fact that this is a very quality company that has grown their business very successfully and very consistently over the years. Okay, now, as a value investor, I'm interested in what is the value of the business today relative to what I have to pay for it. Okay, so I will then put monthly closing stock prices on the graph here. All right, now what's interesting, this was a growth stock for many, many years, and you can look at the rates of growth down here at the bottom of the graph. Very simple. It's all just laid out there for you. You can see that we had very high rates of growth, 12%, 18%, 37%, 26%, 33%, 22%, 10%. Then, of course, even during the Great Recession, the company actually grew. A lot slower. It only grew at 6%, and then 8%, and then 6%. Then we had this very flat year here of 2%, but then we strung together about 4 really good years here, and you can see how the stock price reacts to that. But the key points I want to make here, and I go on and on, you can see the growth rates are beginning to slow down as I get deeper into the more current time frame here. But we saw a period where Amgen's stock price was very inflated. Back here, the PE ratio was over 67 times earnings. And we see that for, almost a decade, this is really a lost decade, this stock didn't make you any money at all. It actually lost you money. And yet this was during a period where the company's growth was extraordinary. Valuation matters, and it matters a lot. Okay, so now we have price and value, but since the Great Recession kind of reset the stock price and brought it back down into reality, it actually made it undervalued. Now, it stayed undervalued, I want you to notice, for several years. That's not uncommon with stocks. But then as the earnings began to build and when they start getting some exciting growth happening again, as you see here, you can see the market reacted to that and the stock price advanced, pretty rapidly here over the next several years during this high growth phase, where Amgen produced about a 22% annualized rate of return from November 2011 through December 2018. So, 7 or 8 years of great growth. But the other important aspect of that is that the price follows that. Okay, now there is the volatility. Yesterday, we had about a 7% drop in price. Now, if I look at it from the forecasting graph, you can see that that's all it shows on this graph. It is not, that material. Now, people get all excited about a 6 or 7% drop, or like I showed with Clorox yesterday, a 10% drop, but things are relative. In this case, this stock was already reasonably priced. It wasn't dirt cheap, but it was reasonably priced. It's now starting to build a margin of safety into the valuation here because of the price drop. Now, as of right now, if I just get a quick quote on Amgen by just simply using the external links here and going to Google, it's up about 2% so far today. It's up $4.44 today. So it's starting to recover. I'm going to get into the company's earnings report here a little later, but I want to stick with the fast graphs here for a moment. Now, this is price and earnings. That's all we have here. Now, another thing that, we graph on fast graphs are the dividends. This company was a growth stock for many, many years. So I'm now going to add dividends, and POR stands for payout ratio. So the area below this white line is the portion of earnings. The green shaded area are the earnings that the company pays out in dividends. And just by pointing to the line, that's all you got to do is point to it. It tells you what the payout ratio was. It's been about 35 to 40% for Amgen in recent years. Okay. Now, then we also take the dividend and we post it on top of the graph so that you can get the perspective. And this is a very clear picture with Amgen, that you get capital appreciation where the price goes from point A to point B, plus you get all this dividend income. I did a recent video on the importance of dividends just a few months ago, maybe a few weeks ago. I'm not really sure now. But anyway, the point is, now you see the company has morphed. As it was once a growth stock and purely a growth stock, it has now begun to morph into a dividend growth stock. And we have this dividend that started out at 56 cents and then almost tripled, not quite, but almost tripled after the first year. And then we've had very good dividend growth. So when I look at long-term performance here, or the period of time since they've paid a dividend, their dividend has grown by over 30% on compound average growth rate, and it averaged about 36% growth. But that includes that 157% increase we saw the first year, okay? So as I shorten the time frame, I can take timing off of this and I start getting much different perspectives, because what I'm doing is I'm now looking at the company when it was fairly valued, okay, rather than it was overvalued. So now when I look at performance, I see that it outperformed the market, paid more dividends than the market, and generated a better rate of return than the market. And remember, I'm measuring here at a time frame where the market also did extremely well. This is since 2011. But again, you see the price tracking earnings, you see bargains, you see slight overvaluations. But when a company is growing at double-digit rates like this, even if you overpay for it, you can still make money. You just don't make as much money as you should. You end up with 7% instead of 10.5% plus dividends, if you will. Okay, so I want to put that all into perspective. I'm going to expand this back out to the all graph. Now, we also calculate a normal price earnings ratio. This is an intrinsic valuation reference line, the orange line, based on fundamentals. This is market value, how the market has valued the stock. Now, this line is very dynamic, and I want you to be clear, those of you who are watching this line drew a normal PE of 19 when I used this all time frame. But now I use these things to evaluate and think and analyze. Now, the reason I say that is because really this line isn't a real relevant line, even though it's mathematically accurate, because you had very high PE ratios here, very low PE ratios here, and only one short period of time in 2014 did this stock, since the Great Recession, trade at 19 times earnings. Otherwise, it traded much lower. So if I shorten this time frame dramatically, now all of a sudden you see this line drop and change. So as we come out of the recession, the normal PE has been about 13. Now, this is more practical and more relevant to me today. And as I, again, continue to shorten the time frame, I start to see that the normal PE ratio stays around that 13 to 14 range and is pretty close to 15, okay? So I'm getting that information handed to me. Statistics don't lie, but statisticians are darn liars. Although this 19 PE ratio is mathematically accurate, it's really not very relevant, I guess you would say, because it really includes a lot of inflated data and a lot of deflated data. And also near-term data is much more important. But again, I now see that the valuation has changed. I see that the growth rate has changed. I see that the company's paying a dividend. And I see that the stock price generally tracks its earnings and has, since coming out of the Great Recession. And I also see now that the company is a dividend growth stock, okay? Now, I'm looking at everything here on adjusted operating earnings. These are non-GAAP earnings, okay? We also have the ability to look at this as diluted or GAAP earnings, okay? Now, there's a significant difference here between the operating earnings, which are more reflective of how the business is doing, compared to GAAP earnings, which includes a lot of stuff like depreciations and amortizations and charge-offs, non-cash events, and so on. And you can see that there is a correlation between GAAP and stock price, but the correlation is nowhere near as relevant as we saw with the adjusted earnings. So let me use this to segue into the company's most recent press release on their second quarter financial result. Okay, and this is directly going into the company's website. By the way, I accessed that by going to my external link and clicking clicking the company's website, but I'm already there. So here we are. Now, here the company gives some very great insights, and this is the kind of thing when I'm researching the stock that I spend quite a bit of time up. Total revenues increased 5%. That's good. Sales increased, product sales increased 3% globally. That's, not so hot. GAAP earnings per share decreased 73%, driven by the write-off of $1.5 billion in acquired process research and development of the 5' Therapeutics company that they recently purchased, okay? So, that's why GAAP is not necessarily a great way to look at it, because there's a lot of non-cash charges including in that. Now, I can go through here, and then I get into GAAP earnings per share decreased 73%, but non-GAAP increased 4%, which I showed you we're using the adjusted operating earnings. Now, this is quarterly data here we're looking at. All right, so the company generated $1.7 billion of free cash flow versus $2.7 billion in the second quarter. That'll become more relevant here a little bit later in this video as well. But anyway, now revenue guidance reaffirmed at 25 to 26 billion. So the company did drop in a little guidance here, and earnings guidance revised to 884 to 890 on a GAAP basis. Okay, so let's look at that. We're looking at a number on the GAAP basis that's going to be reduced from what we see here. But if I go to the adjusted operating earnings And again, that data just hasn't come through yet. It's only been yesterday. It'll probably be through later today, by the way, on fast graphs. If I look at the company from a non-GAAP basis, they're saying reaffirmed earnings at $16 to $17 on a non-GAAP basis right here. So I look at the fast graphs and we've got earnings of $16.47. That's almost halfway between the numbers that they report here. They're saying $16 to $17. And the analysts then are forecasting $16.47. So this is consistent with the guidance, but it's also a negative growth rate from last year. I want you to note that we're looking at a negative year now. And so the stock price, hasn't done much this fiscal year, and it certainly hasn't done much since it was slightly overvalued in 2020, but it is tracking the earnings. Now, earnings are expected to begin growing again. Okay, but let's look at forecasting for a moment now. When I look at forecasting, I'm using a PE of 15 here, just like I did historically, based on a growth rate of about we'll call it 7% going forward. That includes negative 1% for this year, followed by 8% over the next 3 years. Now, if it does generate this level of earnings, and if it does, trade at a 15 PE, which has been historically reasonable for the company, as I illustrated here by looking at this orange line, and even going back here to the longer time frame. If I look at this from relatively long periods of time, we see that a 15 PE has been a very credible valuation reference, if you will. So if I do that, I can say this company can generate double-digit returns for me going out for the next 2 or 3 years. Now, I also showed you with these historical graphs that the normal PE has been slightly lower, averaging about 14. That's the blue line here. And these lines, so 14 to 15 times earnings becomes kind of a range, if you will. So I can look at 13 and a half times earnings here. I've got it already pre-built in the fast graph. I just point to it. I can get 9%, if it does achieve that at the 13.5 PE. At the 15 PE, I've got 12%. And if the PE was a little higher, I'd get 15%. So this gives me a range of probabilities. This is what I mean when I say running the numbers out to their logical conclusion. I'm looking at the company from a standpoint of what it's capable of doing based on, the numbers that I currently have. But now there's other very important aspects of the forecasting graph that I think need to be looked at. And that is, 6 months ago, analysts were expecting $16.90 for 2021. Then 3 months ago, that dropped to $16.20. Now, the most previous estimate has been $16.47. So we've had, strong number here. It reduced dramatically. Now it's moving back up a little bit. And that's kind of where we are. And then we have the similar situation going on for the next year, 2022, where we had 18 at one point, $14, dropped to $17.65, and is moving back up to $17.82, which is what the current estimate is. Okay, so, bottom line is that, the estimates of this company are pretty good, but how good have they been? I also had a comment in a recent video. The guy said, this tells you how worthless analyst estimates are. Well, a lot of this has to do with company guidance. Remember, I pointed out that the company gave guidance here in this press release, and as I go deeper down into this press release, by the way, I can look at what they how they did with each of their product offerings, so I can really dig into the detail of the company. All right, but I can also find additional guide. I look at cash flow and the balance sheet, which I'm going to do here in a moment, and then I can look at 2021 guidance. Okay, and the company gives guidance that is very consistent with what you currently see on the fast graphs. Okay, that's the point I want to make, is the fast graphs is reflecting not only just what the analysts have decided, but also what the company decided. But if I look at the analyst forecast, this company, and all this really tells me is that Amgen either beat or exceeded the estimates 25% of the time on a one-year forecast, and they hit it with a margin of error built in, because forecasts are never perfect, 75% of the time. And they literally hit everything within a margin of error of 20% when the analysts were making a forecast 2 years out. Now, what does that really say to me? All that says to me is the company gives good guidance. That's good, because the analysts are going to rely a lot on what the company says and a lot of what their projections are for each of those products that I showed you. But I go through that process. Okay, and I look at that, and now I also then like to go into the actual earnings call, okay, and look at the slide deck here. And in this slide deck, I can get a great deal of information on the company. This is my process of trying to determine whether I believe this company is, worthy of investing in the future. I know what the past has been because I've got real data there. I'm now trying to piece together a perspective, if you will, of what the future might bring. I can look at all of their products here, how their sales have been. I can look at, discussions of how each of these products have gone, it goes on into the company. I can look at their pipeline. I can look at new products like, this one's for lung disease, I believe, lung cancer, I believe, a new product they have out or, they're getting approval on. So I can go through this whole process here, which I do, by the way. I'm just going to save you, the issue of doing that. But I also like to look at the company's financial statements. Now, here I've gone into fund graphs, which we call fund graphs, which stands for financial underlying numbers. And I'm starting out by looking in the millions, all right? And one thing I'm looking at is common shares outstanding. The company announced a large buyback, okay? Now, I like a company buying back shares when their stock price is cheap or reasonable. I don't like a company buying back shares when their stock is expensive. Now, I want you to notice in 01, 02, and 03, Amgen actually issued stock, okay? So if I go back here and look at as far back as I can go and look at 2001, 2002, and 2003, I see that the price was the valuation was very, very high. So the company was issuing shares when their valuation was extraordinarily high. I really like that personally. Now, when I look at where they started buying back shares, note that the price got cheap after 07. When I look at where they were buying shares, you can see that they started buying shares in 05, 6, and 7, and they continued to buy back shares. And all that time, they're buying back shares during a time when the stock price has been very reasonably priced. So I believe that's good use of shareholder capital, because part of the reason why this company is now paying a dividend is because they really don't have the ability to reinvest their capital and grow. Now, they're making acquisitions and doing stuff like that. So that's kind of, important. And that takes me now to take a look at their balance sheet a little bit. So I'm going to just simply open up the balance sheet, and I'm going to start. The first thing I want to see is cash and cash equivalents, because this company has notoriously maintained a lot of cash. Now, what's interesting is to check that cash against total debt. And what I want you to note is that Amgen has historically had almost enough cash to completely amortize their debt at any time if they choose to. Debt has only been slightly more than their cash. Now, they recently made the acquisition that I announced earlier, and so that, depleted some of their cash temporarily. But, we're going to be looking at, are they going to be able to repeat this? And I'll be watching that in the future. This is quarterly data here. Are they going to be building up their cash? Now, they did point out that they made $2.7 billion in free cash flow. Okay, so let's take a look at cash flow for a moment. Now, operating cash flow, has been, growing over the years, and it's been capable of amortizing the debt, because not only do they have a lot of cash and so on, if I go back to the balance sheet and look at total long-term debt, most of their debt is actually long-term debt. Let me clear some of these out here so you can see this more clearly. Most of their debt is long-term debt, so, they only need enough cash flow to generate the ability to cover their debt. All right, so I want to then take a look at free cash flow for a moment. And I see in free cash flow that, they are going to generate slightly less free cash flow this quarter than they did last quarter. I don't have it reported yet, but it'll be coming in here in the next day or two. They had ended up at about $2.7 billion. So, the company is a cash cow. It's got a very strong balance sheet. It does have debt, but it's capable of amortizing that debt. And I really like the fact that the company has been, using shareholder capital to buy back shares during the time, as I mentioned earlier, when the stock price was cheap. So, that's all positive to me as a shareholder. Now, there's a lot of other places I'm going to look here. I'm going to go into the ratios graph, and I'm going to look at other valuation ratios. Here's enterprise value to EBITDA, a metric that I like, and we'll be adding to the new fast graph, by the way, in a pretty cool version here once we get the launch done. But it's trading at on the lower end of its normal enterprise value to EBITDA. But keep in mind, this was during a period when the stock was very inflated. This is the period of time when the stock price has been reasonable. as we see, back here on the fast graph chart. So what I'm doing is I'm going through this company, I'm thinking about it, and I'm using my powerful tool here just to help me put all this stuff into perspective. And that's what makes it's such powerful and so easy to use. I've got all this data laid up for me. I don't have to go looking through financial statements, etc. Now, the other thing I like to do is I have external links. I subscribe to Morningstar. I like to go into Morningstar. I will go into things like the Wall Street Journal, and I'll look for articles. Now, one thing caught my eye when I went to the Wall Street Journal here is that Amgen is going to be disputing an IRS claim that it owns $3.6 billion in back taxes. Now, the reason I bring it up now is because if I go to Morningstar, I can get a lot of information on Morningstar. They're talking about Amgen is still battling the pandemic pressure. They've lowered their fair value. They give it a lot lower fair value than I do. And that's their opinion. My opinion is that the stock is worth about what it's worth, slightly more than it's currently trading at. They do talk about some of their products. They talk about their business strategy. But one of the things they talk about, they do point out that they give this a wide moat. I think that's, important because it is one of the leading biotech companies in the world. But one of the reasons why the company is kind of lowering their fair value estimate is because they originally modeled a 15% long-term tax rate, okay, and then a blended 21% tax rate and a 10% tax rate for foreign, which gave them 15%. They now assume a probability-weighted U.S. tax rate of 26% and a foreign tax rate of 21%, so that raises their tax rate from 15% to 22%, which is going to have an impact on their earnings going forward. But keep in mind, Amgen is going to be disputing that. Now, I also go to other research sites like Zacks, and Zacks has some very interesting, opinions on the company. They talk about what they did. One thing I like about him, they do give me a history of all of the acquisitions the company made, so I can kind of evaluate that into my thought process and so on. And, I just continue to go through this process. I'm going to go to the new version of Fast Graphs here. It's not quite ready for prime time. As you can see, we don't really have the prices updated. Most of the data is updated, though. But one new item we're going to be adding are price to sales. Now, by the way, everyone's asking when this is going to come out. Guys, we're working very hard to get it out. As you can see by looking at this here, we're getting very close. We're working on things like the portfolio section, and it's going to be very interesting and exciting. We're working on fund graphs and getting fund graphs set up, so that you have more metrics and the ability to show you a lot of stuff on the fund graph. So we're working feverishly to get it done. But the point I want to get at is that as we're going through this, Amgen is rapidly advancing its innovative pipeline. They have growth products are performing well. They do have a deep pipeline. So I'm just gathering all the information I can on the company. At the end of the day, and this is the part that I want to end the video with, that I consider to be most important. The company has an earnings yield of 7.24%. That's not quite a massive margin of safety. I'd like to see the stock cheaper, obviously, but I do have moderate, margin of safety. I like at least 6.5 to 7. I've got 7.24% earnings yield here. Blended PE is only just under 14. Dividend yield is 3.8% and is expected to continue growing. The company's A- rated, which I like. Now, as I go through, I've already gone through the prices. The key is I'm not expecting the historical performance that, I saw when I could buy this company cheaply back here when it was growing at double-digit rates, and I could get performance that was, 12 or 13%. I've tempered that a little bit. It's more of an income play now. But because I have more income factored in now than I had back then, when I look at performance, I really still have double-digit rate of return potential in this stock going forward. I've got an extremely high-quality company with a good dividend record, a good yield, and I can use it as an income play. So this is kind of how I go through the process. To end this, Amgen's price dropped 6% yesterday. To me, that was a non-event. It just gave me an opportunity to add to this stock at a lower valuation if I wanted to. But I've owned this stock for a long time and I'm doing quite well with it. And I still believe it's meeting my goal of investing for income. So the other side of this whole story is know what you are investing for when you invest in your stocks. If you're looking for growth, you're looking for income, and just make sure the stock fits the criteria that you're looking for. It's been Chuck Harwell saying thanks for watching. If you like this, ring the bell, give me a like, subscribe to the channel. And by the way, take a free trial of FastGraphs. We have a freemium version now where you can just try it for free, no credit card, no nothing. Play with it for a while and see if it can help you as much as I believe it's helped me. Thanks for watching. Look forward to talking to you guys again real soon.